The broadcast is now starting. All attendees are in listen-only mode.
Good day, ladies and gentlemen, and welcome to today's webinar, Global Economics, Politics, and Your Offshore ETF Portfolio. We're lucky enough to have Chris from Core Shares with us today, who's going to be presenting. Before we get going, I just want to check that everyone can hear my voice and see the screen. So if you can just raise your digital hands, that would be very appreciative. Great. Okay, so I can see everyone can hear me. Lots of hands going up. Thanks, everyone. The presentation should be roughly about 20 minutes, and then we'll do 10 minutes of questions afterwards with Chris. So I'm going to hand over to Chris now. Welcome, Chris. And I'm just going to please share your screen with us.
Sure. Let me know if you can see it there.
Yeah, there we go. It's just popped up.
Okay, fantastic. Thanks, Stuart, and thanks to the Standard Bank online team for hosting us again today. Also, a big congrats. I'm not sure if you saw on your home screen there, but Standard Bank won the best overall stockbroker in Intellidex annual stockbroker review. So if you're clients of Standard Bank and you're tuning in, good choice. But yeah, thanks for the time again, Stuart. If you want me to kick off, or if you have any other announcements.
No, that's all. Please kick off us.
Sure. So once again, thanks guys. Thanks for tuning in to today's webinar. I'm going to go through about a 20-minute slideshow on global economics, politics, and your offshore ETF portfolio. It's probably not going to be your kind of stockball presentation, and you'll see why. But if you have any questions, please drop them in the question box, and then once we've gone through it, we'll field the questions and take them. So my name's Chris Rule, as Stuart mentioned, and I represent the Core Shares business. We're a passive asset management business. We have a number of ETFs which are listed on the JC. So we're going to be chatting about global economics and politics and how it impacts on your ETF portfolio, and then how should you construct a global ETF portfolio, a reasonable global ETF portfolio to best navigate this complex world of global economics and politics. So what do we mean when we say, what is global economics? What is politics? And quite simply, when we're talking about global economics, we're talking about indicators, or we're talking about factors such as inflation rates, we're talking about interest rates, we talk about GDP or current accounts, etc. We're talking about currencies. So we're talking about, on a macro level, how the economy interacts with itself, and how the impact of various economic indicators or economic factors would impact on your investment return or your ETF return. So things like interest rates are very easy to see and very obvious, but things like GDP and perhaps current accounts are good indicators to look at the country level when you're making an allocation towards a specific country. So typically a country with a good GDP growth rate and a positive current account, so it doesn't have a current account deficit, in other words, the country is not in debt, typically that would be a positive indicator of why you should be allocating your money towards a specific economy. And so when we talk about global economics, we're talking about all of these kind of things bundled up. So it is a very dynamic field to study, and it's not always simple to understand exactly how the impact of the different indicators will play out in the ETF portfolio. But we'll try and chat to that a little bit later, and why I mentioned that this might be a little bit different to your typical kind of global economics and politics webinar. So that's the global economics on the one hand, and then politics, is something that's also very important, or political risk, when you're making allocations to specific countries or specific geographies. So things like government policies, so we're talking about growth policies, we're talking about all kinds of policies. We hear it on the radio all the time, education policies, infrastructure building. Trump's been talking about infrastructure build-outs. We're talking about policies like tax, laws and regulations, relative stability of government. So we've seen in recent history there's a high level of relative instability of most governments, both developed and emerging markets. And then one that's very close to home at the moment, which is the corruption level. Of course, if there's a very high level of corruptions, then it doesn't bode well for a specific economy. So just broadly, when we're talking about global economics and then politics, these are the kind of things we're talking about, and they're all bundled into one broad topic, which is generally spoken about as your global macroeconomics and politics. So the difficult thing with these indicators, inflation rates, interest rates, government policies, government stability, etc., is typically they are very difficult to predict. In fact, just last week, The Economist released an article saying how poor investors are at predicting politics in the global context. So if you have a look at these, did we predict negative interest rates? Did we predict low interest rates for this extended period of time? And then the more obvious predictions, things like, did you predict the financial crisis? Did someone predict the tech bubble or the emerging markets crisis of the early 2000s? So typically the problem with these big economic and big macro market events is they're very difficult to predict. So from an economics perspective, as an investor, it's very difficult to position your portfolio appropriately to take advantage of something that you're predicting in the future, because most likely scenario is that you're not going to predict it accurately or correctly. Politics is not different. In fact, in recent history, we've seen a political environment that's even more difficult to predict. Brexit, for one, was notoriously or was quite unprecedented insofar as it was a very unlikely scenario in terms of the polls or in terms of what people predicted. So not many people predicted Brexit. Same with the US elections of late. Donald Trump being inaugurated as the USA president. So these events, although they have massive impacts on our portfolios, let's take America, Donald Trump, and Brexit, for example. Brexit, of course, was massively negative for the GBP, for the Great British Pound, and the UK markets in general. Trump being voted in, although people don't always have the best opinion from him, had a massively positive impact on the US economy based on some of his potential policies and so on and so forth. In fact, was labeled the Trump trade, where US markets rallied extremely hard post and still are post the Trump election. So, these events have big impacts on our portfolios that are very difficult to predict. And in fact, that little bar there that says hindsight is 2020 is very true, and it's very true when it comes to investing, where when you look back in hindsight, these things seem very obvious and very easy to predict. But in fact, in real time, they're very difficult. And just to kind of illustrate this is the most recent Bloomberg Markets, just a little extract, Bloomberg's Markets magazine. And the question that was asked before, like very prominent key financial market gurus, was what market drivers are on your radar? In other words, what do you think is very important? And these are all from the likes of UBS, Goldman Sachs, Schroders, which is a massive investment management house, etc. And interestingly, on the left, we've got the first guy saying the euro is the next opportunity to betting on, and then the Goldman Sachs guys are saying that the quantitative easing is coming to an end, so Fed's going to raise rates, and the US dollar is going to rally to the detriment of the euro, etc., etc. So you see here 4 global leaders or thought leaders and practitioners in this world of trying to navigate political and economic environments, and they all have divergent or different views, and all have different predictions, and they're all well-founded. So, to be able to predict this going forward is very difficult, especially for any investor, but especially for an investor, who's part-time or who's doing it, not at his full-time occupation. So this is a little bit concerning that these global politics and global economics are really difficult to predict, and historically have had massive impacts on the portfolio. But what are these impacts? Like, let's take the Trump trade. What impact is that? And you can see here the impact of different currencies and of how different political regimes and different macroeconomic environments have impacted your currencies. So this is just a snapshot from 97, which looks at four major currencies, or three major currencies in the rand. We'd like to think of it as a major currency, but with the euro, the Japanese yen, and the GBP, all relative to the dollar. And as you can see, all four of these currencies have behaved quite differently over that period. So the ability to predict that in advance is very difficult. But there is impact. You know, the Japanese policy did have impact on how the currency played out, so on and so forth. South African policies and political environment has had impact on how the rand has played out relative to the dollar over long periods of time. The same, of course, can be said for markets. These are global markets in the home currency. So the Japanese market, the European market, the UK market, the US market. And I wonder how many of you would have guessed in the home currency that over the last 10 years, the South African market has been the best performing market relative to its peers. Of course, we've had massive political instability and quite a lot of economic headwinds in general as a function of commodities slowdown, China slowdown, et cetera, et cetera. So, you know, the illustrative point of these slides is to say that all of these events have significant impact.
Sorry, Chris. Do you mind just repeating that? Your sound's coming and going. Mind repeating that and maybe speaking into the mic if you're not doing so already. Thanks.
Yeah, sure. How's that now?
Yeah, that's a bit better. Let's see how it goes.
Okay. Just shout if there's a sound issue, please.
Will do.
So, what I was touching on is that all of these economic and political environments that each market is exposed to has an impact on the outcome of your investment, specifically if you're making a global investment. And interestingly, I wonder, before I showed this, how many of you would have guessed that the South African market in its home currency, so in rands, would have been the best performing market over the last 10 years. We've heard about the US, the US bull markets of the S&P 500, etc. But in fact, in rands, 10 years ago, you would have been best placed to put your money into the South African markets. So, of course, this is all in home currency, so if translated back into US dollars or hard currency is a very different scenario. And the point is that these are all of these markets have impact based on political and economic basis. I mean, if we take a look at the Japanese market from about 2012, you can see over here a massive impact on Japanese equity markets as a function of their style of quantitative easing when they were actually buying Japanese equities. So that kind of political influence has had massive impact on your portfolio if you were invested in Japanese equity markets. I suppose the question is, if the South African market returns are so fantastic and it's so difficult to navigate the market, why do we look offshore? And I just want to remind you that this is the issue of investing only in rands or only in South Africa, is that in general our currency depreciates quite significantly relative to hard currency peers, and we've got a lot of country-specific risk in South Africa. So just to not to derail the topic, but investing in a global portfolio is a good idea. So I guess I've probably left the average viewer on this webinar, or most viewers in this webinar, even more confused. How do we navigate this global market without overexposing ourselves to specific risks, as in political risk or economic risks? So here are a few things to consider. Consider country-specific risk. So we've made the decision to go outside of South Africa. We're going into global developed markets. And one should try and avoid making an over-allocation to a specific country. And that de-risks the opportunity for you being wholly invested in, sorry, I'm going to scroll back here, in, let's say, the worst performing equity market over this period being the Japanese market. So country-specific risks are risks that relate specifically to that country, and they typically relate to things like GDP growth, like interest rates within a country, like political risk, political uncertainty, etc., etc. Another thing to consider is, of course, you have your underlying market return, but then you also have the return as translates to the relative currency. So let's say Japanese yen or US dollar. So what you have to also consider is how your currency, when you're making an allocation to a specific country, would be impacted, would impact your overall return. So let's say the South African market was the best performing market, but because the rand depreciated so significantly over that same 10-year period, in fact, on a dollar basis, it's probably one of the worst performing markets. So it's very important to consider the impact of currency on your portfolio. And then, of course, there's a home bias. We've done some stuff about home bias in previous webinars. A home bias is the tendency to invest far too much in your home currency or your home economy, like the rand or like South African equities. So to be cognizant, and if you're going offshore, you're probably avoiding a home bias to a large extent. But it's something to consider when making allocations. And of course, home bias relates to some structural biases that exist. In other words, your retirement fund must be invested a significant portion in local markets. Your home that you potentially own, or your flat or apartment or whatever, that would be a South African asset. So structurally, you are forced to have South African assets. So you should consider a global portfolio in that context, trying, of course, achieve the key outcome of diversification. So one way to avoid all of this is to diversify away from country-specific risk factors, from currency-specific risk factors, and then from the home bias. So that's really our message today, is not to try and predict necessarily exactly what country or what political regime is going to be best positioned over the next 5 or 10 years, but rather to hold a broad, diversified portfolio of global ETFs. So what would a country-specific risk look like? So let's say this is a perfect example. You were sitting in South Africa, and through your online stockbroking account, you were going to start allocating to some global ETFs. Now, when you're doing that, you thought, okay, let me buy, I don't know, some S&P 500. So off you go to US. You thought you'd buy some UK exposure, so you buy some UK exposure. But you've been reading a lot, and you're really excited about the prospects of the Japanese markets. So you go and you take, let's say you've got 100,000 Rand to invest, and you put 75,000 Rand in Japan. And you do that because you've done all your homework, and you think, this is a fantastic opportunity set. But what you actually are assuming in this portfolio is massive amounts of country-specific risk, massive amounts of currency-specific risk, and you're ignoring the global opportunity set. So what we would encourage when constructing a global ETF portfolio is to try and get an idea of what the world actually looks like. So here's the world index. In other words, this is the world weighted by the size of each market. And what you'll see is that this is a broad, diverse basket of securities underlying, and it diversifies away a lot of country-specific risk, a lot of currency-specific risk, and generally would leave you in a better position based on, regardless of how politics or economics pan out over the long term. So this gives you an example of a world index. Of course, you can deviate from this. And I mean, this is just for illustrative purposes. But you can see, if you were invested 75% in the Japanese markets, like in the previous example, you're taking a massive bet on Japan relative to what its actual representation is in the world economy, and so on and so forth. So what we would encourage is you to consider country-specific risk factors, in a similar way that you wouldn't want to put all your eggs in one basket by investing in one share. You probably don't want to put all your eggs in one basket by just investing in one country. But to avoid political risk, to avoid country-specific risks as relates to the economy and politics, we would encourage you to make a broad or broadly diversified portfolio of ETFs, like in this example. the good news is that most of these exposures that I've shown you are available to buy on the JSE through your online stockbroking portfolio. And you can invest in them simply by buying each exposure to a different company. You get country-specific ETFs, so you can buy a Japanese ETF, you can buy a UK ETF, you can buy a USA ETF. You can also buy world ETFs, which gives you simple world exposure. And why they're so efficient is because you can buy them in rands. You don't have to deal with making generally expensive foreign exchange transactions with wide spreads and high minimums. And you get exposure to both the underlying equity markets and currencies. So that's the good news, is that you can actually create this portfolio on the JSE and get a broadly diversified global ETF portfolio by simply positioning yourself and making a reasonable allocation across different countries, rather than making bets on one specific country. Of course, you also have to consider that the JSE has a large offshore component. In fact, around 35% of our top 50 index, or our market, South African market, relates directly to companies which are listed in developed markets like the London Stock Exchange, the Swiss Stock Exchange, etc., the German exchange. So you do get some offshore components just by buying local assets. But we would really encourage you to consider looking for what we call genuine global diversification, and that's actually buying those large globally listed ETFs, which are available on JSE. So as I mentioned earlier, this is not your typical webinar on CoreShares having a view on which market we think is probably going to be the best. We think that European equities are attractively priced, and relative to the US, the valuations are attractive, and the currency is well positioned. We would encourage a long-term buy and hold strategy where you're not trying to time specific markets, but rather hold a diverse basket of ETFs, which gives you exposures to different markets and therefore different currencies and different equities. And what you're doing is you're diversifying away a lot of country-specific risk, which can significantly impact your portfolio if you're overexposed to one country relative to a basket of countries. So that's it from us in terms of global economics, global politics, and your portfolio, and how to position your portfolio. Of course, what I've given you is kind of an idea of what the world looks like. You don't have to invest in exactly the same proportion as that, but it would be a reasonable starting point. We're going to take some questions and stuff now. If you have any questions, please shout. Stuart's going to handle the questions, so I'll let him pick and choose which questions he's going to ask, and I'll try my best to answer them.
Thanks, Chris. Really appreciate the presentation. Right, everyone, as Chris said, just please drop your questions in the questions box, and I'll feed them on to Chris, and I'm sure he'll provide more than adequate answers. So there's one from Sudeshan here. He's asking, are any of these global ETFs part of the tax-free portfolio? So I can actually answer that one. Yes, they are. Chris, I think all of at least the CoreShares ones are part of are tax-free compliant, if I'm not mistaken.
Correct. In fact, I think so. Certainly, all the CoreShares global ETFs are tax-free compliant, and as far as I understand, all global ETFs at present are tax-free compliant. The only ETFs that aren't tax-free compliant are typically the commodity ETFs, but otherwise, all the collective investment scheme ETFs, which CoreShares are.
Yeah. Thanks for that. Are there any other questions from anyone? I'm not seeing anything arrive in the box. Just give it a little while just to see if any come through. And please, if anyone ask Chris anything. We'll, even if it's a little bit off what he said today, we can always try our best to answer.
Absolutely. Please feel free to ask us any questions.
Here we go. Some are coming through now. That's great. So Kasongo wants to know if the global portfolio ETF is rebalancing as the different I suppose share values across the globe change. I mean, I know you guys have a global one. You maybe give us
So
some feedback.
yeah, so if you were to buy a world, ETF, like I showed in the illustration here, as the holder of the ETF, you actually wouldn't do anything. You would simply hold that ETF, and as the countries which were represented in the ETF grew in market size, they would take up a larger portion of your portfolio. Typically, a global ETF would be rebalanced quarterly, and that would be, but that would be quite a marginal impact on your country exposure. For example, let's say USA at 51.9%. If there was a rebalance, it most likely wouldn't move by much. That would be a gradual change. So you wouldn't see significant changes in your country allocations in the short term. So yeah, I hope that answers your question. But
Great.
That's typically how it's managed.
Yeah. To sum up, it basically rebalances once every quarter, in line with the world index. Right. So Fred, I see you asking, what is the cost structure of the ETF? I'm not sure which ETF you're referring to exactly. Perhaps, certainly Chris would be able to comment on the cost structures of the core shares ETFs. Chris, would you mind maybe giving some insights?
So ETFs, global ETFs on the JSE, I'll just touch on that broadly. Their cost structures range quite a bit. So they range from around, I think the cheapest, and there's no TER yet, but the cheapest ETF on the market at the moment is around 35 basis points. And that goes all the way up to 90 basis points. So CoreShares has two global ETFs. We have a global property ETF, which gives you global exposure that looks a lot like this. This slide I'm showing you over here, that TER is going to be around 0.55%, so 55 basis points. And then we have an S&P 500 ETF. S&P 500 ETF would just give you exposure to the USA market, and that TER is also around 0.55%. So that's where those two ETFs are priced. As I say, they range quite significantly from 0.9% to, let's say, 0.35.
Okay, great, thanks. Then Mike would like to know about ETF reinvestment of dividends as opposed to a cash distribution. I don't know if you guys offer anything like that. I know like this, the Satrix RAFI reinvests dividends and then grows the value of the ETF. I don't know. You guys don't have a ETF that does a similar sort of thing?
No, we don't. All of our ETFs distribute semi-annually or quarterly, depending on which ETF. Our global one semi-annually. In fact, there isn't in all ETFs on the JSE, they one or the other. So it's not an investor choice, if that makes sense. So you're either investing in an ETF that reinvests its dividends or distributes. So it's not an investor election. Stuart, I'm not sure on your guys' side if you have any functionality on your platform that reinvests dividends, but I don't think so.
No. So it would have to be on our platform manually reinvested. I think the question was just in line with if there's any specifically your offshore ETFs that do this. I know you can get some local ones that do. But let's move on to. I think that answers it. So let's just move on to the next one. Fred would like to know if you invest in a CoreShares offshore ZAR denominated ETF, like the ones that you list on the JSE, do you benefit from the fluctuating exchange rates? And if so, how does this work? So I think you touched on this earlier. Maybe you can just flesh it out a bit more.
Yeah, 100%. So let's use a very simple example. So let's take the S&P 500 as an example, because it's just simple US dollar exposure. You invest in South African rand. Let's assume the S&P 500, in other words, the underlying equities, go up 20% over the year that you're invested. So if the rand dollar exchange rate remains constant over that whole period, your return in rands would be 20%. So let's say the rand dollar exchange rate was exactly flat. So it started at 13 rand and it finished at 13 rand. You would have a 20% return. Now, if the rand depreciated by, let's say, 20% to the dollar, then that would translate to you as a gain. So that would mean you'd get 20% from the underlying equity return, plus you'd get 20% from the currency movement. So it's a pure rand hedge. In other words, you're getting pure dollar exposure. So in this example, your total return as an investor would be 40%, which means you benefit from a weakening rand by investing in these global funds. If, of course, the rand strengthened relative to the dollar by 20% and your underlying equity return was 20%, that's a negative for you as you're investing in dollars effectively. So that means your return would be 0%. So in short, the impact is significant on your return in rands, depending on the underlying currency. And when you're investing in global ETFs, which are denominated in rands, you effectively are buying a rand hedge. In other words, you're protecting yourself against a weak rand.
Great. Yeah, I think that answers it sufficiently. See, what else have we got here? So Lionel would like to know which of your ETFs have a capping policy. Which ones? What is the policy? I'm not familiar with the capping policy, so maybe I can learn something here too.
Yeah, sure. So in terms of our global ETFs, the S&P 500 fund doesn't have a capping policy. Typically, a capping is only an issue when you're in smaller and concentrated markets like South Africa. Our global property ETF actually does have a capping policy of 10%. It's a much smaller market, and there are a few large heavyweights, so that is a 10% cap. Where it's really relevant for investors, and sorry, I'm stepping away from the global theme here, is in our local market where Naspers is around 21% of our top 40 index. And we have an index which is very closely representative of the top 40, which is our top 50 index. So, in fact, that index which I showed you here, that light blue line, that top 50 index, it has a cap at 10%. So in other words, your largest share exposure won't be greater than 10%. In this case, Naspers effectively is capped, and that weight is distributed proportionately along the rest of the portfolio. So those are the only two ETFs that we have a capping methodology on.
Great, thanks. So Loram, I see you asking if we can share this presentation. I'll ask Chris afterwards if he's all right with it, and if so, then we can put it on the website. If not, well, unfortunately, we won't be able to help you. And Yopi,
we're happy to share the presentation.
Sorry, you're happy to share the presentation. Great. All right. So in that case, I'll put it up on the website afterwards. Again, this recording will also be available afterwards, so you can actually watch back everything Chris has to say about the slides as well. I think we're going to end it there. That seems to have covered most of the questions. So thank you everyone for attending. We really appreciate your time, and thank you, Chris, again, and the CoreShares team for coming back on and doing a webinar for us.
Yeah, thanks, Stuart, and again, thanks everyone for tuning in. We really appreciate it.
Great. Thanks, everyone. Have a good day. Cheers. Bye.